People are being told once again that the system is stable, that volatility is under control, and that another margin hike will calm the silver market just like it always has. The message is familiar, comforting, and repeated with confidence. But what if that confidence is misplaced? What if the tool they rely on the most no longer works the way it used to? Because every time margins are raised, the reaction looks predictable on the surface. But underneath, something very different is happening. And today, I want to explain why the next margin hike is likely to fail, why silver keeps pushing back against control, and why this repeating cycle is becoming more dangerous for the financial system every single time it resets. Silver has always been different. It doesn't behave like most assets. It is not just a commodity, and it is not just money. It exists in an uncomfortable space between both. It is used every day in industry, technology, energy, and medicine, while at the same time being held as a hedge against currency, weakness, and systemic risk. That combination makes silver extremely sensitive to stress. When confidence starts slipping anywhere in the system, silver reacts early, sometimes quietly, sometimes violently. That's why when silver begins moving faster than expected, the response is almost automatic. Margins are raised, leverage is reduced. Traders are required to put up more cash to maintain positions. The official explanation is always the same: risk management, market stability, protection against volatility. But the real purpose is control. Margin hikes are designed to slow momentum, force liquidations, and restore confidence in the paper market. Before we go further, if you want honest explanations instead of surface-level headlines, make sure you like this video and subscribe to Global Silver Truth. It supports this channel. It helps this information reach more people and ensures you don't miss what's coming next. This channel exists to explain how the system actually works, not how it wants to appear. Now here's what most people never hear. Margin hikes do not eliminate risk. They simply move it. No margins go up. Smaller traders are forced out first. Participation shrinks. Liquidity dries up. And positions become concentrated in fewer and stronger hands. That may look like stability, but in reality, it increases fragility. Fewer participants controlling larger exposure means less flexibility when stress returns. Prices might fall temporarily. Volatility might calm down for a short time. Commentators declare the problem solved, but nothing fundamental has changed. Supply has not increased. Demand has not disappeared. Trust has not been restored. It has only been delayed. Silver doesn't rise because of speculation alone. It rises because something deeper is shifting beneath the surface. And margin hikes do nothing to fix that shift. History makes this pattern impossible to ignore. In 2011, silver surged rapidly, drawing attention, excitement, and fear. The response was aggressive and immediate. Margin hikes came one after another in rapid succession. Each one was framed as necessary, responsible, and corrective. And yes, prices collapsed. But what actually caused that collapse matters far more than the price itself. The selling was not voluntary. It was forced. Traders were liquidated not because they lost conviction, but because the rules changed. Forced selling destroys confidence in price discovery. It teaches participants that markets are not purely driven by supply and demand, but by intervention. And once that lesson is learned, it is never forgotten. When the dust settled, the real problem was still there. Physical demand had not vanished. Supply constraints had not eased. The system had simply bought time, and that time has now run out. Today, the environment is far more fragile than it was back then. Debt levels are dramatically higher. Governments, corporations, and households are more leveraged. Interest rates are unstable. Confidence in banks and institutions is weaker. And the gap between paper silver claims and physical silver availability is wider than most people realize. Open interest remains massive relative to deliverable supply. Registered inventories are thin. At the same time, industrial demand continues to rise. Solar panels, electric vehicles, electronics, medical devices, and defense systems all require silver. That demand is structural. It does not disappear because margins go up. Investment demand is also changing. People may argue about inflation numbers, but they feel purchasing power eroding. They see costs rising. They sense instability. And silver benefits quietly from that awareness. The participants still active in the silver market today are not naive. These are institutions, funds, and industrial users who understand margin hikes perfectly. They expect them. They plan for them. Many of them already hold enough capital to meet higher requirements without exiting positions. So when margins rise, instead of breaking demand, the market tightens. Fewer participants. Larger positions. Less flexibility. That is not stability. That is pressure building silently. This is where the crisis loop becomes obvious. Silver begins to rise. Stress builds in the paper market. Margins are raised. Prices pull back. Confidence briefly returns. Then physical demand quietly absorbs available supply. Inventories decline. Leverage becomes more concentrated. And the next move begins from an even tighter base. Each cycle leaves less room for error. Another effect of repeated margin hikes is psychological. They train participants to expect intervention. When intervention becomes predictable, behavior changes. Traders adapt. Investors adjust. More people decide that paper exposure is not worth the uncertainty. Physical silver does not respond to margin hikes. It does not get liquidated because of rule changes. It does not care about leverage requirements. It exists outside the paper system. That shift is subtle but powerful. At Global Silver Truth, silver is not viewed as a quick trade or a speculative bet. It is a signal. The margins go up, and silver refuses to collapse the way models predict. That is not just strength. That is stress leaking through the system. The financial system depends on confidence. Confidence that contracts can be rolled over. Confidence that liquidity will always be there. Confidence that intervention will work again the next time. But confidence weakens each time the same tool is used with diminishing results. Silver does not need to explode overnight to cause problems. It simply needs to remain stubborn. It needs to stay elevated. It needs to behave differently than expected. And that is exactly what it is doing. Now consider what happens if the next margin hike fails to stop momentum. What options remain? Margins can be raised again, but that risks choking liquidity even further. Verbal reassurances can be issued, but words lose power when actions repeat. Rules can be adjusted quietly, but that only deepens suspicion. None of these options restore trust. They weaken it. Once participants believe prices are managed rather than discovered, behavior changes permanently. People hedge differently. They hold differently. Prepare for instability instead of trusting stability. And systems built on leverage do not function well under those conditions. This is why silver keeps breaking the system, not violently, but persistently. It exposes contradictions. You cannot promise unlimited paper claims backed by finite physical supply forever. You cannot suppress volatility without increasing fragility. And you cannot rely on the same intervention repeatedly without consequences. Each margin hike that fails sends a message. Control is getting harder. Flexibility is shrinking. The problem is not solved. It is postponed. And postponed problems return larger. Silver reflects that reality better than almost any other asset. It reacts to pressure, not narratives. It does not respond to reassurance. It responds to imbalance. As we move forward, don't focus only on announcements. Focus on reactions. Watch what silver does after pressure is applied. Watch inventories. Watch delivery demand. Watch how quickly confidence returns, or whether it does not return at all. That is where the real story lives. This channel exists to help you see those patterns clearly. Global Silver Truth is not about fear or hype. It is about clarity. Because once you understand how these cycles work, the noise loses its power. Before you go, I want to hear from you. Do you believe the next margin hike will finally control silver, or do you think it will expose even more stress in the system? Leave your thoughts in the comments. Share this video with someone who still believes silver is just another commodity. And make sure you are subscribed, because what comes next will matter more than most people realize. Silver does not destroy systems overnight. It reveals what was already broken. And every failed attempt to control it makes that reality harder to ignore.